Canada-based Sundial Growers Inc. (SNDL) produces and markets cannabis products for the adult use market. Its stock has gained 76.6% over the past year, benefiting from a growing domestic and international cannabis market and from optimism surrounding the potential legalization of marijuana in the United States at federal level. However, the stock has lost 15% over the past month. And the company's underwhelming quarterly results do not bode well for its stock price in the near term. Although SNDL has gained some popularity due to the recent Reddit frenzy, unless and until there is more certainty over a large-scale legalization of cannabis in the United States, the company may continue to face difficulties increasing its revenues. Here's what we think could influence SNDL's performance in the near term. Weak growth prospects. While the recreational use of marijuana was legalized in Canada in 2018, the Canadian market is still too small for cannabis companies to grow their bottom lines significantly. It could take a considerable period before Canada's marijuana market is sufficiently developed to cater its large potential consumer pool. Unless less federal decriminalization or legalization occurs in the US, Canada-based cannabis operators like SNDL will have great difficulty increasing their revenues in the crowded cannabis space. Unimpressive quarterly performance. Even though SNDL's net revenue increased 8% sequentially to $13.9 million in the fourth quarter, ended December 31st, the company reported a net loss from continuing operations of $64.1 million and an adjusted EBITDA of negative $5.6 million over the period. Furthermore, SNDL's sales, marketing and general and administrative expenses increased 6% to $8.8 million in the fourth quarter of 2020 from $8.3 million in the prior quarter. Unfavorable analyst estimates. Analysts expect SNDL's revenue to decline 52.9% in the current quarter and 21.2% in the quarter ending June 30th. Also, the stock failed to beat the street's earnings estimates in any of the trailing 4 quarters. Lower profitability. SNDL's trailing 12-month negative gross profit margin of 81.9% is significantly lower than the industry average. Also, the company's negative EBITDA margin and levered free cash flow margin compare poorly with positive industry averages. Ratings reflect bleak prospects. SNDL has an overall F rating, which equates to strong sell in our rating system. The ratings are calculated by considering 118 different factors with each factor weighted to an optimal degree. Our rating system also evaluates each stock based on 8 different categories. Among these categories, SNDL has a grade of C for momentum, which is consistent with its price decrease over the month. It has an F grade for sentiment, given analysts' pessimism about its earnings and revenue growth. In addition, SNDL has a D grade for quality. This is justified given the company's lower than industry profitability ratios. Bottom line. Like most of its industry peers, SNDL's impressive price performance over the past year shows that it has also capitalized on the optimism around the potential large-scale legalization of cannabis in the United States. However, the company has been struggling to stay afloat financially. So, we think it's wise to avoid the stock now. Thank you for watching this video. We appreciate your continued support. For more daily news, please subscribe to our channel. This is Economics Empire and we'll see you in the next one.